Welcome back to my video. So a quick analysis on trades that have been taken. Now I'm sure you guys must have seen the picture I posted about this particular trade right here. This one. I posted it before this movement. You can check my previous last two posts. You see the entry right there. So now I just want to give my idea what I was looking out for before taking this trade, right? So it's off from the monthly. That's one thing that you guys should first of all know. It's off from the monthly time frame. I'm sure if you have been watching my videos, you have heard me spoke a lot about speak a lot about VG, reverse fair value gap. This is the monthly time frame, and I know that on the monthly we are in a reverse fair value gap, and we've hit um this fair value gap right here, this fair value gap. And I'm expecting this candle like this month to close bearish. That was like a bias that I had. Like I was seriously expecting this monthly candle to close bearish. Why was I expecting it to close bearish? Because we're in a reverse fair value gap and we are reacting from this fair value gap again, and there was a sharp rejection. And before that trade, before that 4 hour trade, this candle was bullish. It was a little bit up, and I was expecting. You can see the um the um the calculator, right? The trades calculator is being highlighted here. So it was bearish. I said bearish. It was bullish. This monthly candle was bullish. So I had the bias that the monthly candle should close bearish, especially now that we are nearing the end of the month. On 22nd, it's running like how many days? 8 days or 9 days for this month to end. So that was the bias I went in with, right? And also on the daily, right? Yeah, I was looking at this crazy uh trend line that has been going on. You can see that it's highlighted here. And also I was looking at this fair value gap. Let me see. Okay, before I talk about that, let's just look at the trade. Before I talk about fair value gap. Now, for the 4 hours, right here was the reverse fair value gap for me. This I posted this also on my page. You can check it out. This was the reverse fair value gap for me. Now you might be wondering what this line is for. This line is just 50% of this reverse fair value gap. So I've been doing something lately where I've been trying to like be more precise about reverse fair value gaps and see how price reacts. So usually expecting to see price reacts from just a little bit above 50% of the fair value gap, but this went all the way in. Mind you, this fair value gap, reverse fair value gap is on the 4 hours, we're on the 4 hours time frame. So this went all the way in into the reverse fair value gap, and I saw this breakdown. Right? This cool. Now, let me also show you something. There's something interesting on the 15 minutes. Right. Let me see if I can find it right here. This this is what was interesting. This fair value gap on the not necessarily even this other block. I was seriously expecting price to hit this other block. Right, this is the other block. Let me highlight it for you. I'm sure you guys must have heard about other blocks and also heard about people bad mouthing what's it called? They say SMC concept, but it's not actually SMC, it's ICT. All SMC price action concept, they are all ICTs. So rather than learning about what's it called? ICT concepts from random people online, it's best you just go watch ICT videos and you'll learn more, right, about other blocks. Now, some people want to pick the last, but this is where the other block is. This full movement up, right? That's the other block, not just the last candle. Now, let me just explain it quickly why that is the other block. And not like I used it, but let me just explain why that's another block. You see this, this is the first candle, right? This is the second candle, the green candle. You can see set of bearish candle, and then you also see this eye. This one first candle, second bullish candle, and then this bearish candle. That's the last eye. Are all other blocks. One, two, three. Why? Because that was the last three candles before price started dropping, and then before we saw this huge drop. Now, usually, what I usually expect for other blocks, right, is when I see, let me see if I can annotate it. Let's say I see price first can bullish, very bullish candle. I see the second bullish candle. I see the maybe a somewhat bearish or bullish candle. Then immediately I see price boom taking out the set of bullish candles. What so when I see price taking out of the set of bullish candles, now if the bias is right, the key levels is right, everything is right, and I see this form, right? I'm not teaching you patterns, because that's one thing, you guys that are supposedly trading SMC concept, because you guys have been bad mouthing SMC with bad mouthing ICT concept. That's the issue. You guys are trying to trade patterns. SMC is not patterns. The other blocks, you don't just go on the chart and start looking for other blocks and then entering trades just because you saw what looks like an order block. That's not how you trade. You have to look for key levels, understand market movement, understand where price is going to from the monthly time frame. You have to understand all that. It's like a story. You don't skip the storyline and start looking for points. It's like you are cramming. So if everything is right, I understand where the market is going to, everything is right, and I'm looking for an entry. If I see this bullish candle, the second bullish candle, the third bullish candle, then I see a bearish candle, takes it out immediately, not this that we are seeing here, oh, like immediately. I will expect price to come and hit this line. So this I will take this one, two, three as my order block, and I will expect price to come and hit the other block before going down, right? But you see, this case is different. After the highest price, we did not see the next candle, this which is this, did not take out this order block. Rather, it was the second candle. So what you should be expecting is price to react from this fair value gap and maybe not necessarily always touch the other block. That's one thing. So price will react from the fair value gap rather than the other block, and then you can put your whatever stop loss here. But if let's assume if after this third candle, maybe after this bearish candle, the next price that the next candlestick, or let's say this one, let's say it took out this immediately. Let's say this happened, right? Let me see. Let's say this happened. Let's say after this last high right here, this next candle one, now candlestick took out in immediately this low, right? If it takes it out immediately, then what I'll be expecting for price whenever it's coming is to come back to react at that at this one, two, three candle, which I'll take as my order block. But since price did not immediately take it out, it was the second leg, and I'll just expect the fair value gap. That's one secret about order blocks that is not taught anywhere. I promise you, it's not taught anywhere. The only person that teaches stuff like this is ICT. Like, if you want to learn about SMC concept, not SMC, is ICT concept, go and watch ICT videos. Don't waste your time watching. Even don't listen to me, sef. I'm just giving you what I learned from ICT, right? So this fair value gap, right? That's like very important. Now, if you can see price react. Now, why am I even picking that other block and fair value gap? It's not. I'm not picking patterns. It's because look at this. Look at it. It's at my reverse fair value gap on the 4 hours. That's the red line that I just drew. This is the red line. It's at a reverse fair value gap. It's very, very simple. So that was why I was looking at that 15 minutes, right? Even though if you look at the 1 hour, it's still the same fair value gap, but the 15 minutes was just if you want to be like overly precise, right? That was it. Then you see the London eye taking out this Asian eye into that 15 minutes fair value gap, which is at a reverse fair value gap, and you just keep on seeing everything lining up. Then it wasn't really hard to just figure out that the market would be bearish. Now, what made me enter, gave out this trade again was this. We saw, we see price like reacting at that fair value gap and all that. We see this push, then we see price. Now, this is the fair value gap. Price was, let me highlight it for you. This video is getting longer than I want intended it to, but I just have to explain that, um, give you guys the advice so you guys can go and learn proper SMC from ICT. Go and watch his videos. His 2016 mentorship. Trading is not about patterns. Go and watch, learn the concept and mentorship. You need a mentor. You need someone to mentor you. ICT does mentorship. And mentoring is in the sense that you are going to have to watch 3 hours of videos, 6 hours videos, and just be listening to him ramble, him telling you what he's thinking at a particular moment while he's looking at the chart. That is what mentorship is. Trading, learning the concept will just teach you what other blocks is. That's learning, you've learned. But what you now need, what most of you need, mentorship, right? So that's like an advice I can give. You can just go on YouTube, search, just type ICT, you will see it, inner circle trader. Let me show you. Right. Let me just show you quickly. Look at this. YouTube, ICT, right? That's him right here. Inner circle trader. You can go there and watch him. It's the guy is a beast. Look at this. I am the mentor of your mentor. I am the ghost in the machine, the author and creator of smart money concepts. That's SMC and what many erroneously called Wyckoff theory. You can I am often imitated. Many have renamed my last work. The guy has been teaching doing private mentorship since early 2000s or 90s. But you will see the source of most things being marketed today as bank trading, SMC, interbank trading, and price action. So everything, what I learned, everything that I know, I learned from him. Everything you are seeing about SMC, most people are just either teaching it wrong and you are learning it wrong. That's why you see many people being frustrated by SMC concept because they are not learning it properly. If you know you want to learn SMC, go learn it from ICT. He is the founder and creator of those concepts. Just good advice. Now let's go back to our trade quickly. This video is getting too long. So right here, I saw this fair value gap. I saw price reacting to it. Then boom, this 4 hour candle closes below this fair value gap. Now, this fair value gap was a reverse fair value gap. And there was also one thing I was also looking at, right? Because I've been trying to like be more precise in my entry on this reverse fair value gap. I was looking at the 50%. I did not draw that properly. Let me delete this. So that's what was that? delete that and draw it properly right here. So right here is 50%. You can see that. I don't know, let me zoom in. You can see the 0.5. This is 0.5. That's 50% of this fair value gap. So now you can see price just going a little bit above the 50% level. So that's also one. So for you, I'll be looking at ways to enter the reverse fair value gap precisely and more clean. That's also one way. So I saw that. Then by the time you check this on the 1 hour, right? By the time you check that 50% on the let me annotate it so we can see it. Let me put a line. That's 76,986.38. Yeah, it's close. 23.9 just 1 point. So you can see it's in the 1 hour fair value gap. The above 50% and above it, it's in the 1 hour fair value gap. So that's also one way you can be precise in your entry. Then you can just put your stop loss above this candle that breaks the reverse fair value gap. Price should not get above it, right? Price might go above 50%, maybe even go outside the reverse fair value gap and not close above it. Maybe just come back in. I think do we have something like that here? Yes. Look at this. Went outside the fair value gap, right? Look at this here. It went outside the reverse favorable but the body did not close, so the body did not close above it, so the reverse favorable gap is respected. So it's possible that for price to right go above this, but it should not go above the candlestick that made it a reverse favorable gap, right? This is the candlestick that closed below this fair value gap and made it a reverse fair value gap. So price should never go above it. So you can put your stop loss there. You also see the same thing here. This was the candlestick, right, that invalidated the fair value gap. Price should not go above it, right? So that was my idea so far. And placed my entry just somewhere above there, and you can see price moving. Partials have been taken, just watching to see. Now, why am I targeting? All right, this is where I'm targeting ultimately. I'm targeting this fair value gap right here. That's fair value gap. That's what I'm targeting. Why that fair value gap? Because that was where price reacted before it started pushing up. So it's as simple as that. So this video is 18 minutes long. I hope you guys watch it to the end and also follow my advice. Yeah. And if you have any question relating to what I just explained, feel free to drop it in the comment section. This is not a financial advice or only for educational purpose. God bless you.